Every trader can mark levels, but almost nobody can answer the real question. When price reaches liquidity, is it a liquidity run that confirms continuation or a liquidity sweep that signals a reversal? If you can't tell the difference, you'll keep entering at the worst possible moment. Welcome to Graph Insight. In this video, I'll break down how to trade liquidity sweeps the same way professional traders do, even if you're a beginner. If this topic is useful to you, make sure to like the video and subscribe to the channel. First, we need to clearly understand what liquidity actually is. Liquidity is simply a price area where there is a large concentration of orders, especially stop losses and pending orders. And if you follow smart money concepts, you already know one key idea. Price is constantly drawn toward liquidity. Liquidity is what fuels market movement. Now, based on market structure, liquidity can be classified into different types. For example, on this chart, we can see a swing high and a swing low. This is what traders call external market structure. But for liquidity, we'll call it external range liquidity. Now, inside that range, we can also spot a bullish fair value gap. That's what we can treat as internal range liquidity. And these two liquidity types are tightly connected because the orders sitting in the internal range are the same orders price uses as fuel to move toward the external liquidity. That's why you should analyze them together, not separately. When you correctly read external and internal range liquidity, you can start to predict future price moves with much higher accuracy. And that's exactly what we're going to cover later in this video. But before we continue, I want to quickly mention that I share daily market analysis and trade setups inside my Telegram community. So if you want to see how a professional trader analyzes the market every day, make sure to join my free Telegram community. The link is in the description. The next key concept you must follow is market structure. And to make it simple, I'll explain market structure through trends. Price can move in three conditions: uptrend, downtrend, or consolidation. In this video, we care mostly about the first two, uptrend and downtrend. But price doesn't move in a perfect straight line like most trend examples show. Instead, it moves with spikes, impulsive moves, and pullbacks. And when you analyze those spikes correctly, you get the information you need about market structure, which we'll use later for our entries. So, let's break this down. When we analyze market structure, we use two concepts: break of structure and change of character. Here's an example of an uptrend. Price starts moving up from this level. We mark this level as a swing low. Below that swing low, we typically have a pool of orders. This is what we call sell-side liquidity. Then price makes a pullback, and after that it forms a swing high. And above that swing high, we usually have another pool of orders. This is called buy-side liquidity. So now we have the external structure, or in liquidity terms, we have our external range liquidity. Next, price pushes higher toward the buy-side liquidity, breaks the previous high, and creates a new swing high. That movement is exactly what creates a break of structure. After that, price pulls back again, and then it breaks the previous high one more time, creating another break of structure. So as long as price keeps breaking swing highs, we treat it as an uptrend. But now look at the next move. Instead of going higher, price starts moving down towards sell-side liquidity, and it breaks below the previous swing low. This is what we call a change of character. It tells us the trend is shifting from bullish to bearish. And from this point forward, the market will form breaks of structure by breaking swing lows. In the next example, we can see that price is moving in a downtrend. So now break of structure is formed when price breaks a swing low, moving towards sell-side liquidity. So to summarize, a break of structure happens when a key structure level gets broken, and that usually means liquidity is being run, which confirms trend continuation. And this is important. You always want to be interested in trading with the trend, not against it. So the real question becomes, how do we know when the trend has actually reversed? In this case, one change of character is not enough. For better understanding, let's take a look at this chart. We can see that price was in an uptrend, creating multiple breaks of structure to the upside. Then price moves down and breaks below a swing low, creating a change of character. At this point, all we can do is suspect a potential reversal, because price can still be doing one thing, a liquidity sweep, meaning it can dip below the swing low, grab sell-side liquidity, and then immediately reverse and continue higher. So to avoid getting caught, after a change of character, we must wait for confirmation. And the confirmation is simple. After the change of character, we need to see a break of structure in the new direction. Only then can we confidently say the trend has actually changed. So here's the rule. Trend continuation is confirmed by break of structure. Trend reversal is confirmed by change of character plus a follow-up break of structure. Now that we understand market structure, we can come back to external and internal range liquidity. On this example, price forms a swing high and a swing low. This is your external range liquidity. And inside that swing, we can also see internal range liquidity in the form of a fair value gap. Like I mentioned earlier, price often uses the orders inside the fair value gap as fuel to reach the external liquidity. That's why during a pullback, price drops back into the fair value gap and then pushes into the swing high, creating a new break of structure. After that break of structure, we can identify a new external range and a new internal range again, and we can expect a similar behavior. But now look at the next price leg. During this move, we get two fair value gaps. So the question is, which one should we use for a long entry? In this case, it makes more sense to focus on the larger fair value gap, because the size of the fair value gap is often proportional to the strength of the imbalance. A bigger imbalance usually means a higher probability of reaction, even if price breaks through the smaller, earlier fair value gap. Now, from a reversal perspective, here's a key idea. If price disrespects the fair value gap and breaks below it, that becomes the first warning sign of a potential reversal. Then, if price breaks the swing low and creates a change of character, that becomes the second signal. And after that, a break of structure in the new direction becomes the full confirmation that the trend has actually reversed. And we can see the same concept in a bearish example. If price wants to break external liquidity on the downside, it often has to tap into internal liquidity first. So it moves into the fair value gap, uses that pool of unfilled orders as fuel, and then attacks sell-side liquidity, creating a new price leg and a new external range. So to summarize, when you analyze external range liquidity together with internal range liquidity, you get a much clearer read on market direction, and you avoid getting trapped by false moves. Now let's break down the difference between a liquidity run and a liquidity sweep, and how you can actually use both for profitable trading. In simple terms, when price reaches an external range liquidity level, two things can happen. Price continues through that level. This is called a liquidity run, or price grabs liquidity and reverses. This is called a liquidity sweep. And this is one of the most painful problems for traders because most people don't know how to interpret this correctly. So let's start with the easier one first, liquidity run. On this example, we have an uptrend and a clearly defined external range liquidity. Price pushes into the swing high and closes above it. But here's the key point. One candle closing above the previous high is not enough to call it a liquidity run. What we need is confirmation, and the confirmation is simple. We want at least one more candle that creates a fair value gap. Now we can see that the newly formed fair value gap overlaps with the previous high. Only at this point we can treat it as a liquidity run because we have reason to believe that this fair value gap will act as support and keep price moving higher. And here's how to execute this trade properly. As soon as price pulls back into the fair value gap, we look for a long entry inside that zone. We place the stop loss slightly below the fair value gap, and we set the take profit at 3 times the stop loss distance. That gives us a 1 to 3 risk to reward. And after the entry, we simply let price do its job. Now let's look at the next scenario. We're still in an uptrend, but this time the fair value gap does not overlap the previous high. Instead, it forms above the previous high. And this setup is still valid because the logic stays the same. We still have an imbalance that can act as a support zone on a pullback. So the execution is identical. Once price returns into the fair value gap, a long entry becomes valid inside the zone. The stop loss goes slightly below the fair value gap, and the target is set at 3 times the stop loss distance. That creates a clean 1 to 3 risk to reward, and price moves into take profit. But sometimes you'll see a fair value gap form below the previous high. And in this case, there is a high probability that price will disrespect that fair value gap, meaning price can tap into it and still continue lower, because the market hasn't truly confirmed the run above the high yet. So here's the rule. If the fair value gap is below the previous high, we should wait until we get a fair value gap above the previous high. Only then do we treat it as a real liquidity run setup for a long entry. And the exact same logic applies in a bearish scenario. In a downtrend, we want to see a fair value gap form overlapping the previous low or below the previous low, because that zone will act as resistance on a pullback. Then we wait for price to retrace into that fair value gap, enter the short, place the stop loss slightly above the fair value gap, and target a clean 1 to 3 risk to reward. Now let's move to liquidity sweeps. On this example, the trend is bullish because price has been creating multiple breaks of structure to the upside. And we also have our external range liquidity marked at the previous high. But this time, when price moves up into that level, something different happens. Price prints a large wick above the previous high, and then it closes back below the level. So it fails to create a new swing high, and it fails to form a new break of structure. And this is a classic sign of a liquidity sweep. Price grabbed the buy-side liquidity above the high and then rejected it. And after a sweep like this, it's reasonable to expect a potential reversal. But we don't short just because we saw a wick. Instead, we follow our sequence. Like I mentioned earlier, the first reversal warning is when price disrespects the internal range liquidity. Next, we want to see price break below the previous swing low and create a change of character. And after change of character, we still need one more thing: a break of structure in the new bearish direction. When this sequence remains intact, we can confidently say that the trend has reversed, and that's when we start looking for short entries. But there's also a high probability setup that lets us enter a short before we get the full reversal confirmation. Here's the idea: if we zoom in on the price leg that caused the change of character, we often find a freshly formed bearish fair value gap. And in many sweep to reversal scenarios, that bearish fair value gap becomes the main retest zone. So instead of waiting for the full break of structure confirmation, we can use that retest to enter earlier with a much better risk to reward. Once price retraces back into the bearish fair value gap, we look for a short entry inside the zone. We place the stop loss slightly above the fair value gap, and we target a take profit at 5 times the stop loss distance. So we get a 1-to-5 risk to reward ratio. This is justified here because reversals often come with increased volatility, which can create a long, clean price leg, enough to hit that extended target. But to reduce risk, we can split the take profit into 2 parts. By closing 50% at 1-to-3 ratio, and then close the remaining 50% at 1-to-5 ratio. As soon as price hits the first target, we reduce risk by adjusting the stop loss. And from that point, the trade becomes much safer. Even if price comes back and hits our adjusted stop after first take profit, we still end up profitable because we already locked profit and reduced risk. And in many cases, after the retest and the continuation down, we'll also see the market print a break of structure, which is the final stage of the reversal. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.